Hello and you're very welcome to this video in our series on economic indicators for junior cycle business based on learning outcome 3.9. And in this video we're going to learn about interest rates, what interest rates are and the impact of interest rates on individuals, business and the economy. So if you've already done the outcome on saving and borrowing, you'll be familiar of this, but what is meant by interest rates? Have a quick think about that there, pause the video, when you're ready press play to continue. So, interest rates are the cost of borrowing money or the reward for saving money. In Ireland, interest rates are set by the European Central Bank. So, can you think about what the impact on interest rates are for various different people in society? First, let's think about individuals or households. So, what would be the impact if interest rates were high and if interest rates were low? Pause the video there now and think about it. When you're ready, press play to continue. So this table here shows us what the impact of interest rates would be on individuals or households. So look on the left there, if interest rates were high, it would mean it would be very expensive for people to borrow money to be able to go and buy capital expenditure. Capital expenditure is what exactly? Can you remember? It is, of course, large once-off expenditure that's going to last a long time. So, for example, buying a new car or a new house, things that people often have to borrow for, well, if interest rates are high, they're less likely going to be able to borrow them, to be able to do that. On the flip side, if interest rates are low, well, then it's quite cheap for people to borrow money. So they're going to be more likely to buy capital products, such as buying a new car for themselves or a new house. If interest rates are high, people with existing loans are going to have to pay more in their repayments for their loans. That's going to affect their disposable income. What does disposable income mean again? Disposable income is basically the money they have to spend, just the discretionary money they have to spend after their essentials are paid for. Whereas if interest rates are low, well, people with existing loans get to pay less in their loan repayments. So, therefore, that means they've got more money to spend on things that they want, increasing their disposable income. If interest rates are high, it's going to reduce the amount of borrowing, which in turn will reduce the amount of household debt, which is actually quite a good thing. You know, you don't want households to have high levels of household debt. But if interest rates are low, it's going to encourage people to borrow money, so it's going to increase the level of household debt. What I mean by the level of household debt is basically the portion of money that a household has to pay back in money owed. If interest rates are high, you're more likely to save money. Why? Because you're going to get a better return on your money. Whereas if interest rates are low, you're less likely going to save money because it may or may not be able to level to the rate of inflation, so you might be better off spending your money now. Pause the video there now for a second and think about what the effects of interest rates are on businesses. So when you're ready, press play to continue. Well, the effects on business would be fairly similar. If the interest rates are high, it's going to be more expensive to expand because you're probably going to be borrowing money to expand. So therefore, you're less likely to expand. But if the interest rates are low, then it's going to be fairly cheap to borrow money. So you're more than likely going to be willing to expand. Again, the same situation with existing loans. If interest rates are high, businesses with existing loans will have to pay back more money in interest, reducing how competitive it is and reducing their profits. Whereas if interest rates are low, they'd have to pay less in repayments, and that'll make them more competitive and increase their profits. If interest rates are high, it means their costs are high for the business as they're paying back loans. So therefore, they're less likely to be able to create more jobs. But if interest rates are low, they may be able to take that gamble of being able to employ more people because their costs are lower. And just like with individuals, if interest rates are high, they're more likely to save money. Whereas if interest rates are low, they're less likely to save money. Pause the video now and have a think about what the effect is for the economy as a whole of interest rates. And you're ready, press play to continue. So, of course, if interest rates are high, that means there's going to be less borrowing in the economy. Less borrowing will result in less spending because people are buying less capital goods. That means there's going to be less economic activity. If there's less economic activity, in other words, less goods and services being bought, that means there's going to be less income or money coming in for the government. How do the money, we talked before about how the government make their money, for example, through taxation. So, for example, through VAT, or property stamp duty or things like that. However, on the flip side, if interest rates are low, then people are going to borrow more. Therefore, there's going to be more economic activity. More people are buying goods and services. Which means the government are going to make more money through taxation. Similar enough, if interest rates are high, then there's going to be less investment in the economy, which will therefore increase unemployment. And if unemployment is high, that means you're going to have to pay more social welfare payments. Can you think of an example of a social welfare payment? And then, for example, job seekers benefit, job seekers allowance, those type of payments, family income supplement, etc. Low interest rates then, well, will encourage more investment, which will create more jobs, reducing employment. Reducing unemployment, increasing employment, I should say, and reduce the amount of social welfare payments that the government have to pay. If interest rates are high, the cost of servicing the national debt increases. What does servicing the national debt mean again? That is, of course, paying back the national debt, i.e. how much the government has borrowed to run the country. Whereas if interest rates are low, the cost of servicing the national debt declines. Of course, if higher interest rates are high, it's going to encourage people to save, reducing the amount of money people are going to actually spend, which would in turn reduce government income and, of course, reduce business profits as well, because people are buying less goods and services because they're more likely to save. But if interest rates are low, it discourages the idea of saving, so people are more likely to buy stuff now. So that would increase consumer spending, increase government income, and therefore increase business profits as well. So, folks, that brings us to the end of today's video, where we now know what interest rates are and what the effect of interest rates are on individuals, business and the economy. Hope you enjoyed this video. If you have any questions, ask below in the comments. If you enjoyed the video, please give it a like, and of course please subscribe to the channel. Thanks very much for watching. Bye now.